we're going to follow up to that high IV bull put credit spread search we looked at last week for Stephen. I don't know if he's here. I haven't seen his name yet. We're going to take a 3-month look at 2 separate searches. So what was the question? Well, last week, Stephen asked, can we create a bull put credit spread on PowerOptions looking for high IV credit spreads, bull put credit spreads, or perhaps bear calls? We focused on bull puts. Or also maybe where the IV is actually increasing and moving up. And we showed 2 ways to do that. This, of course, is on YouTube, the one we referenced there. There's the YouTube link down at the bottom, or you could go to YouTube and just screening for high or increasing IV on the PowerOptions by the title. Now, what we did with Stephen's question, we first went into the optionable stock statistics, found that the average implied volatility last week across the entire market was at 0.72. So we ran a search with a little bit higher than the average general IV, and we talked about how he could look quickly with one link to see the IVs were increasing in that case. But he also wanted a minimum credit of 45 cents for the sold option premium and the total credit on the position, 75% probability or higher, and of course, we're going to avoid earnings between now and expiration. During that discussion, we talked about some of the risks of the high implied volatility. Comparison-wise, same strike, same expiration, 2 different stocks, a higher IV is going to naturally lead to a higher premium. We all know that. And Stephen also was looking for positions with an increasing implied volatility, hoping for an IV crush so we could maybe buy back the sold put or the spread early for a lower price if that decline happened while he was in the trade. And we talked about that, of course, in the previous webinar. Most importantly, though, higher IV usually points to higher potential risk on the horizon. Maybe a known event is coming up, not necessarily an earnings or something along those lines. It could be a phase 2 or phase 3 drug trial, a court ruling on the company that's coming out. That burned me once as well. Or just the general stock performance or the industry that it's in. These stocks tend to swing more wildly with the higher IV in any strategy, which could result in large losses, especially in a leverage position, such as a credit spread or debit spread. High IV can be a double-edged sword. Well, let's just do a quick 3-month test. We're going to take one of our default searches on the bull put credit spreads, the weekly bull put default screen, against the high IV screen that we created last week looking for Stephen's position. Now, we started on July 12th. Initially, when I was running these tests today, I was going to start on July 6th, but that was a Tuesday because the market was closed on the 5th of July in observance of the 4th of July holiday. So we actually started on July 12th, almost took us 3 months here to October 8th. Now, how we run this test is we have a background program that we use that just churns it out for us. It's different than the historical testing tools, but if I manually used the historical backtesting tools on the site, it would have gotten the same results, just would have had to calculate them manually. We start with a $100,000 account, but we only allocate 15% of that to trade the credit spread positions. We're going to open 3 positions on Monday that come up matching the default criteria. We're going to allocate 5% to each trade. We're going to set a stop at about 50%, usually when the stock price reaches within that 1% or gets near the short put strike price. We're going to close the position at the time. If it's a big drop down at a pre or after market hours, we might get closed at a 60 or 70% loss because that's all the market can give us. Well, running that test from July 12th to today, the $100,000 account ended up within $110,700, a 10.7% increase. But we only were allocating $15,000, so we could argue that was a 71% return against the $15,000. There were 22 total trades from July 12th to closing out that portfolio today, only 2 losses and 20 wins, so it was a 91% success rate. The average win on the winners was 16.9%, and the average loss on the losers was about 54.8%. On July 13th, I think it was July 14th, actually, when this NVIDIA position was closed, right after it was open, one of the first positions, when we ran the search on July 12th, it was closed out because it had a decline and the loss was 60%, more than the 50% we like to take because that's all the market could give us. A firm on October 4th was closed for a loss of 49.5%. The biggest drawdown during this time was at $95,892, starting off from a $100,000 account, and that was mostly due to the July 17th NVIDIA position. For the high IV screen, we used the same time frame, July 12th through today. We avoided earnings. We used, oh, I'm sorry, Chuck, let me go back. I'm sorry, yes, Chuck. The biggest drawdown was $4,108, not $95,000. That was the lowest account value. So the biggest drawdown was only $4,108. Sorry, Chuck, I didn't explain that very well. Thank you for that. Okay. So yeah, the account only went down to a value of $95,892 because the loss on the $5,000 or so that was allocated to the NVIDIA position that took a loss the day after the trade. That was the lowest point. All right, so the high IV screen again, taking the same time frame, avoiding earnings, same capital, $100,000, and $15,000 allocated to the spread, same allocation, and the same stop. Same expiration time frame, 18 to 17 days, opening positions 2 weeks out. The ending amount on today, on October 8th at 4 p.m. Eastern Time, was $89,582 for the higher IV bull put credit spreads. That's a loss of 10.4% from where the portfolio started. Or it was a 69.4% loss of the $15,000 we allocated to this position. There were 23 total trades and only a 57% success rate, 13 wins and 10 losses. The average win was 23%, which we'd expect, much higher than the standard initial screen, and the average loss was minus 54%. The biggest drawdown was about $11,200, close to the ending amount. On October 4th, the total account value was $88,822, screening for positions with that higher implied volatility, higher premium, higher average return, but many positions swung drastically against the structure of a bull put credit spread, so the losses were taken as we would normally take loss in this position because we can't afford to take a 70, 80, or 90% loss. We have to close it when it hits a 54% loss. And by the way, looking back at the 10 losses on this test, none of them came back. Yes, all of them were closed when the trigger was hit. The average was a 54% loss. There was a 72% loss in there, I think, on the total results of the 23 trades. There was a 38% loss. They got worse after that, after the trigger was hit, either the 50% loss or the stock hitting or reaching near the short put strike price as well. None of the 10 losses recovered to a positive zone. They all stayed worse losses or about the same as you went further to expiration. Now let's just table that for a comparison. The weekly bull put up at the top here, we had 22 total trades over this 3-month time period. 20 wins and 2 losses, so we had a 91% success rate. Average gain is 16.9%. Average loss was 54.8%. The ending portfolio, starting with $100,000, only allocating $15,000 or 15% of that to trade this strategy, 3 positions that match the search criteria. So we had a gain of $10,700 or 10.7% on the portfolio, or you could say 71% of what we allocated. The high IV search we created last week for bull put credit spreads only had 23 trades, only 13 wins of the 23 total trades, of 57% win rate. Average gain was higher, 23%. There were some 32 and 33% positive returns in those positions. But again, if you don't have a win ratio near 75, 78, 80%, you're not going to be successful. Taking 54% losses, the ending amount of the portfolio is $89,582 for loss of $10,418 or 10.4% over that 3-month period with the higher IV positions. Now, Chuck asked, this is just a test, right? Yes, this was a test I ran on the same time period to just compare those with the top 3 positions that would have matched each search and taking that against one another, using the same stops, same allocation in that case. Since July, my win rate with the bull puts following the same pattern. I don't take the top 3. I do a little more research into each one when I run my search on Monday to find the bull puts that match that criteria. My win rate is about 87% since July 12th or July 6th, based on what I looked at. And my average gain on the winners is only about 13.8%. My apologies from what I looked at, just taking an average. And the average losses on the losses I took is a little bit less than this. Is about 51.2%, I think, over the last 3 months in that scenario. So sometimes I only open 2 trades in my personal account. Sometimes I'd open 3. As you know, from a week ago, I skipped the September 20th series and waited a week because I didn't like the market activity on that Monday. And we all know why. That was the Evergrande decline and fear and spark in the market, Chuck. So I did not have as high a win ratio. This is just a test using the historical screen, taking the top 3 results that matched on each Monday that we ran the search to open the 2-week out positions. Same day's opening for both screens in that case, with the stops we would normally use in that scenario. And that brings me, of course, to the disclaimer, Chuck. The spread strategies, as we saw, do involve risk. Leverage trades may not be suitable for all investors. Past performance is no guarantee of future results. Any spread trading, credit spreads, debit spreads, condors, even short strangles, short straddles, any approach should be analyzed thoroughly to make sure you're comfortable with that scenario. Proper position sizing is key for any leveraged option strategy. Imagine if we had run that high IV screen, where we actually traded over this 3-month period, but we allocated 50% of our total portfolio to this, or 60%. That would have been heavy, heavy losses that we took on that strategy. In that case, probably be very hard to get back to break even until many, many months down the road. Of course, this is also just a 3-month test, Chuck. So 3 months does not the market make, but we wanted to have a follow-up because we created a search last week for Stephen, and I just wanted to show him a basic idea now that we had it. Expectations might be going forward, you're going to see wild swings with those kind of high IV positions going into bull put credits. You don't always get the implied volatility crush you're hoping for. Sometimes the event that was the reason for that high implied volatility comes before the volatility goes in your favor, and you end up taking more losses in that case before you can get those profits on the position.